Good morning and welcome to Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Let's take a look at what's going on here or what happened on Friday. I pull up the chart. This is just a candle glance chart giving you a look at many of the different indices around the world. You can see that the U.S. markets rallied pretty nicely on Friday. The Dow Jones Industrial Average finished up 373 points. The S&P 500 up 41. The NASDAQ up 110. Russell 2000 gaining 15 points. New York Stock Exchange, you can see up more than 1%. Really across the board, really nice rally. When we look globally, don't see quite as good of action as we've seen here in the U.S. You can see that many of these indices are still a little bit off of their highs, whereas the U.S. did make a lot of headway back toward those prior highs. But overall, when you look at the U.S. indices, you see that last week was a very volatile week. If you went away for the week and just looked at the end of the week, you probably wouldn't think much changed. But if you were watching it like we do, you know that there was quite a bit of volatility, a lot of selling midweek, very poor manufacturing report. The ISM manufacturing data came out, and it showed contraction with a reading below 50. Anytime we go below 50, that indicates that we do have economic contraction. That spooked a lot of folks thinking we're going to have a recession. And, I'm not going to say we can't have a recession. I don't believe we're going to, but in a secular bull market, it has happened, and it does happen occasionally. You do have recessions. They generally don't last very long, and a lot of times the market shrugs during a secular bull market. So we'll see how things unfold, but I'm not overly concerned about it at this point. I think the market overreacted last week, and I think that's why we saw a lot of this buying coming in throughout Thursday and Friday. One of the things we did here at Earnings Beats is we started getting a little bit more aggressive toward the end of last week. I thought it was an opportunity with the market selling off on that manufacturing data to get in. I think there's going to be a run-up heading into earnings season. I would not be surprised to see the S&P 500 break to an all-time high as we head through earnings season. So for that reason, I felt like it was a pretty good opportunity. We had 4 alerts out last week, all doing pretty well. We'll see how they do today. I can tell you that the futures are a bit lower this morning. Last time I looked, the Dow Jones down about 50 points, S&P 7, NASDAQ around 20. Looking at the Treasury market, the 10-year Treasury yield currently up 3 basis points, 1.54%. The oil prices, crude oil, up about 1.5% back to 53.64. I think that was getting close to a key support area. Talked about that a little bit last week. I would not be surprised to see oil have a much better week this week. And then gold down $9.50. The dollar firmed and gold moving back lower. I think gold's in trouble. I really thought the dollar might pull back, but it hasn't. It continues to show strength. And anytime the dollar's got strength, and also if the S&P 500 continues its rally off last week, I think that a lot of that, the appeal of gold is probably going to wear off a bit. Certainly on a relative basis, I expect gold to underperform if the dollar continues to strengthen. All right, let's take a look at a couple other things here. I do want to bring up the sector so you can take a look at what happened here last week. I was pretty encouraged. And one of the things I'm encouraged about, and I'm going to talk about this more tonight at 4:30 when we have our Q4 market outlook. I'm looking at these top 5 charts, and these are the aggressive sectors: technology, discretionary, communication services, industrials, and financials. And when I look at these, and this is just a 4-month candle glance chart, but I had an uptrend in all 4 for the 2 months. And then, of course, August, September tends to be a little bit rough for equities. But I think during this period, we're simply setting up these continuation patterns. So when I look at the technology group, I see the rising lows, equal highs or relatively equal highs. That to me looks like an ascending triangle. Discretionary stocks, I think it's much clearer. The highs are basically equal. Lows in place here are higher, nice hammer. We saw a big reversal last Thursday on all of the major indices and all the major sectors. We were down very early in the day, and then we saw buying throughout the day and a nice rally on Friday. So I think what we've done with that move down on Thursday is establish a key short-term low. And I look for the market to push higher from here and hold that low from Thursday. Now, if we go back down and we lose the Thursday lows, then we've got to reevaluate, maybe look at some other patterns. Instead of this maybe being an ascending triangle, it may simply turn out to be sideways consolidation, which is exactly what we have here in communication services, where we have equal highs, didn't put in a higher low. We actually came all the way back down to an equal low, but still off of an uptrend, sideways consolidation, rectangular consolidation. That's also a continuation pattern. Industrials, this one actually looks a little bit more like a channel. We actually saw the industrials break out. And this is one of the things that, I don't know, when I saw the economic report come out last week and the weak economic, the weak manufacturing data, industrials right before that report, 2-3 weeks before that report's the only group breaks out to the upside. That makes no sense to me. The market, I think, is looking ahead. And I think that also is what Thursday and Friday tells me, is that while a lot of folks are looking at the data from a month or two ago and thinking, oh my gosh, here's another sign of recession. CNBC probably called their 13th recession of 2019. I think the market's telling us something different. And industrials breaking out when all the other aggressive areas could not. That tells me maybe the tide's turning here a little bit. We'll have to see how things develop into the fourth quarter. But if we go back up and industrials break out, financials break out, we might see a little bit of rotation in leadership, but still within the aggressive areas, which I think is very bullish. Let's move on to the, 10-year Treasury yield. And what I'm going to do today, I didn't really go through a recap at the beginning or an agenda, but I went through the market recap a little bit with you. I'm going to show you the 10-year Treasury yield here and a couple other charts. And I'm going to get into some upgrades, downgrades, talk a little bit about relative strength, maybe a brief earnings spotlight, some of the stocks coming up for earnings. There was actually one company that raised guidance earlier this morning. We'll talk about that. And then I always like to end my show with 3 you must see, so 3 charts. So you want to stick around for that. But let's take a look at the 10-year Treasury yield. Now, I wrote about this morning in my Trading Places blog, and I really find that there are some things that are extremely important. In my belief that the market goes higher, there's some things I'm going to be looking for. And one of the things that I really want to see is the 10-year Treasury yield moving higher. Now, in this is a chart of the S&P 500 on the top. This middle panel right here is the 10-year Treasury yield, the TNX. And then down at the bottom shows you the correlation. This is a weekly 10-year chart. So this goes back throughout the bull market. And one thing that I think is really important to point out is that the direction of the S&P 500 and the direction of the 10-year Treasury yield is mostly positively correlated. It's not positively correlated all the time. It's just mostly positively correlated. And to me, it just makes common sense, because the 10-year Treasury yield, when the bond market believes that the economy is going to strengthen, the bonds will be sold off. And when bonds are sold off, the yields rise. That's always a 100% inverse correlation. Bond prices and bond yields always move inverse to one another. So when you see the yield going up, it basically is telling you people want out of bonds. You have to ask yourself, why would you want out of bonds? Well, if the economy is strengthening, you're going to want out of bonds because the stock market will benefit from a strengthening economy. S&P 500 multinational companies are going to benefit. Their profits are going to go up. When their profits go up, PE multiples go up. When all that happens, the stock market goes up. So do you want to be sitting there holding bonds yielding 1.5% when you've got a potentially runaway stock market? Of course not. You want to move over. So when market participants, portfolio managers, whatever, are looking at the stock market, they're always making a decision. Do I want to be in bonds? Do I want to be in stocks? How much do I want to be in bonds? How much do I want to be in stocks? And you'll see them sometimes say they're shifting their allocation from 60% equities and 30% bonds to maybe 70% and 20%. and leaving 10% cash. That's important because that is the type of rotation that really drives a bull market. So when I look at this chart here and I highlighted in blue these blue shaded areas, what happens when the 10-year treasury yield is rising? You see these big moves in the yield to the upside. Now, of course, we have periods where it's coming down. I just want to focus on what happens when the yield goes through a period of rising. We've been coming down for a year, and we're getting close to some key lows. It makes sense to me that we're going to bounce. So what happens when the treasury yield moves higher? Well, in 2018, right here, when we moved higher, you can see the S&P went from 2,500 to over 2,900. Pretty good move. Back here, huge move, huge quick move in the 10-year treasury yield. We went down a little bit during the period, but overall, we ended up going higher, up about 10% during that period in the S&P 500. The only time it really didn't work out too well was back in 2015. Here you can see we had a pretty decent move, and we just kind of sputtered. I don't think we went down, but we didn't really go up. Just kind of consolidated here in 2015. Look back to 2012 and 2013. This big move coincided with one of the best moves in the bull market. And then you go back and you just, highlight any of these moves to the upside, and you can see it coincides with rallies in the stock market. And it makes sense because when money is coming out of treasuries, usually it's going to be money that wants to go into equities. So as we move down, this is the thing that really is encouraging, is that while we are going down in the 10-year treasury yield, we're consolidating. Back in 2015 and 2017, or 2014 and 2017, we actually went down, and the bull market rallied throughout that. But usually, it's kind of like it was in 2015 and 2016. Move down in yields, and the stock market struggles. Because usually the things that send the 10-year treasury yield lower are the same things that scare the stock market. So when you see the yield going down, it means probably something's going on in the economy that's not too good. Maybe thinking about the Fed maybe having to cut because, cut rates because economic conditions are deteriorating. And that normally will be associated with weakness in the stock market. But you can see the last couple of times here, when we went down, market kept going higher. Here we're going down, market's still trying to go higher, although we did have some panic in Q4 2018. All right, anyway, I think this is going to be a big thing to watch in the fourth quarter, and something I'll talk about again later this afternoon. But the S&P 500 definitely will benefit if the 10-year treasury yield begins to move higher. Now, one thing I mentioned on the sectors, or maybe didn't mention, should have mentioned a little bit more, was the financials having such a big day on Friday, Thursday and Friday, big reversal. And yet when we look at the yields, we see that the yields have been tumbling. So why would financials be doing so well? Well, I wanted to show you the yield spread, which is the difference between the 10-year treasury yield and the 2-year treasury yield. And you can get this on stock charts by simply typing in $UST10Y minus $UST2Y. Just gives you the difference between the two yields. Notice that over the past 6 weeks or so, this has actually been moving back up. We went from an inverted yield curve, went negative. That's what scared the market. One of the things that scared the market, but now you don't hear about it because we're going in the other direction. And so now that's not anything that CNBC needs to worry about anymore. But now that it's starting to widen again, it's starting to drive more people back into the financials. That's why financials are beginning to show some pretty decent strength. Banks pulled back last week like the overall market, put in that hammer on Thursday, came right back on Friday. This is a big level up here. It's been struggling to get through about 466, 467. This would be a positive if we can get the banks through that 466, 467 area. So we'll want to keep an eye on that. One individual stock in the news this morning is First Solar. And First Solar, the Trump administration removed tariff exemptions for bifacial solar panels. And Bloomberg was reporting this should provide First Solar an edge against its foreign competition. You can see the stock had gone down. I'm going to stretch this out and put it on a relative chart so we can take a look at it. At stock charts, it's in the semiconductor space. I kind of look at it as a renewable energy stock, but I guess however you look at it, I'm just looking at this breakout back here. It looked like we went just below and then turned, and I think that First Solar now is beginning to right the ship again. But here was that breakout I was talking about right here. So you got this double top, made the breakout, good volume coming in on this gap up. There's also gap support right here if I just put that up a little higher. But I'm going to take it down to this price low in the double top that we had. But you can see this reversal Thursday and Friday came right at that level. We got some more work to do to get through these moving averages, but last time I looked, I think First Solar was up about 4 or 5% pre-market. So should get a nice pop. We'll see whether or not it can close back up above those moving averages. To the upside, I think it's pretty clear. We need to get through $68 on First Solar. Close above 68 with heavy volume, and I think that would be pretty bullish. All right, let's go into upgrades and downgrades. There were a few of them here that I wanted to mention. And let's see here. All right, let's start with AYX. This is actually in our model portfolio. I own AYX, just full disclosure there. They did get upgraded today. The stock was up when I looked about $2 or $3 pre-market. It's going to have a test today at the 20-day moving average, 114.87. I would love to see this stock kind of follow the lead of some of the other software stocks that made some pretty good moves last week. I know Coupa Software, COUP, had a huge move. There was another one I'm trying to think of. It got an upgrade and went straight through the 20-day. I'm kind of hoping that we see the same thing today with AYX. If it could start making a move, all of a sudden, this downtrend could, off of this longer-term uptrend, begin to start to look like a cup from a longer-term perspective. And if you pull up a weekly chart, you might see that even a little bit better. You know, on the daily chart, it looks like everything just complete devastation. You come over here to a weekly chart, you say, well, you know what? The stock had been up almost every single week for 3 months. Maybe it just needed a little rest before we go into the next earnings report. So if we start to move higher again, get through the 20, we could see one of the software leaders, AYX, beginning to strengthen again going into an earnings report, which I think would be very bullish. So AYX, interesting for sure with its upgrade. A couple of others here, ETFC. Remember, a lot of these brokerages announced free trading, free commissions, or zero commissions. A lot of them, well, they were all hit hard last week on the news, now starting to bounce back. Getting an upgrade, I don't know. We're going to see whether or not we can get through 39.5. I will say E-Trade and Ameritrade are much more heavily dependent on their commissions in terms of revenue than, say, Schwab. So I don't know. E-Trade and Ameritrade, I have my doubts. I think it's probably going to take some time to settle, for those stocks to settle. So I wouldn't be surprised maybe if there's a little bit of a head fake to the upside with the upgrade. We'll see. Match.com, Match Group, MTCH, downtrending for a while, but pretty much holding on to this support area right before the huge gap up with earnings. So I think as long as this stock continues to hold $70, I think it's okay. And with the announcement or with the upgrade today, I think you're going to see the stock move back up above the 20. And I wouldn't be surprised to see this begin to make a run back up toward highs heading into earnings season. We'll see. Uber got an upgrade this morning. It definitely needs one. I will say this, higher PPO, lower prices. Most recent high up at around 34, and that's exactly where that 50-day moving average is, which is what I look for after a positive divergence. So here's that prior high. Here's your 50-day. I wouldn't be surprised to see a quick pop on Uber. I think it's going to get back through its 20-day moving average, make a run toward the 50. From there, I think we'd have to reevaluate. Last one, this is another stock. This is one of our alerts and also in our portfolios. ZBH, Zimmer Biomet, was upgraded today. The stock came down. We love this one. This is the reason it got upgraded, or why we put it out as an alert. I'll just show you this gap support. This is one of my favorite ways to trade the stock market. I love these companies that come out with these nice candlesticks on very, very heavy volume and keep going higher for a few days. because it just tells me, if you know the way the market works, when everybody wants to buy, market makers are on the other side of the trade providing liquidity. Well, if they're on the other side of the trade shorting, they usually win. That's why a lot of gaps fill. When they get on the other side and prices keep going higher, it's telling you there's a lot of demand for the stock. So as this price goes higher, I don't necessarily want to be chasing it, although I think somewhere around this time it did go into one of our portfolios. But from a trading perspective, now our portfolios we hold. We don't trade. So don't mix the two up. We've got a trading portfolio, or we have a kind of a 90-day buy and hold portfolio, no matter what. And then when I talk about trading, I'm talking about short-term active account. So when ZBH comes down here and hits this 130 area, 131, to me, you've got a tremendous reward to risk, because if this stock holds its gap support and moves back up toward its high, which is what most uptrending stocks do, you've got $11, $12 of upside. You only have a couple of dollars to the downside. So you're setting up a trade that's got about 5 or 6 to 1 reward to risk. So trading is not about being right all the time. Trading is about managing your risk so that when you lose a little. When you hit for more. That's the essence of short-term trading and trying to make money doing it. So ZBH looks really good. I'm not surprised. I see this all the time. Stock comes back down. It's selling off for 5 days. Seems like nobody wants it. Well, guess who wants it? Probably the same company just upgraded them. Probably the same firm. They probably built a position for many of their clients and come out and upgrade it. I mean, is it crooked? Yeah, but it's legal. It's definitely legal. Anyhow, ZBH I think looks pretty good. I think I saw the bid was up, 0.5% or something. I don't know. Getting back through these moving averages through 137.50 would be a big deal for ZBH. I think that would likely send it back up toward its recent highs. Downgrades, might as well take a look at a couple of these. None of our stocks were impacted, although there were a couple in the I think there were a couple in our strong earnings chart list that got downgraded, but they could become opportunities. We'll have to see where they go. ALGN, I'm just going to show you a couple of these real quick. Align Technologies, downgraded. Stock got all the way to the 50-day moving average. Really is in a downtrend, bear flag. I'm not seeing anything here that I like. Not surprised by the downgrade. One stock that is in our strong earnings chart list is Herman Miller. This one now probably is going to be down with its downgrade, but I actually think somewhere around $45 wouldn't be bad. I mean, if it's down $1 on the downgrade, might not be a bad opportunity. This is a stock came out with its earnings, gapped up to a new high, came all the way back down. It has filled its gap. I think one more downgrade, I think you could see accumulation and right back up to $49. Would not surprise me. All right, I'm going to move on now to relatively speaking. I'm going to go through here kind of quick, but this is in the sector area. The XLK versus the S&P 500, I wanted to point out where we broke out last week to a new relative high. The S&P 500 hasn't broken out, and people are calling for a recession. Why would technology be breaking out on a relative basis to a new high? Don't know. That one would floor me. So wanted to point that out. Moving on to the industry groups. One thing you can do, and this industry group chart list is something that we send to anybody who's an annual member at Earnings Beats and also has at least an extra membership at Stock Charts. And the beauty of this, I've got all of the industry groups in this chart list relative to the S&P 500. And if you click on View All, you can go down and look at them 10 at a time. But I'm going to view the list in summary form. And let me show you this. This is pretty cool. You've got them all listed, and they're showing the relative strength from Friday. But you go up here to the period, and you can see over the last week what has really been driving the market. Or if you're saying, okay, over the last month, maybe it's the last month you want to see what's been driving the market. You can get a sense for the types of areas that are leading to the upside. But if you go back to that 1 week, look at home builders. Home builders just continue to thrive in this market. Huge breakout on a relative basis. This is an area of the market we absolutely want to continue to take a look at and focus on. I've talked a lot about these home construction stocks in the daily market report that I send out every day. A lot of individual trading possibilities with charts that I've put in there. I really like the home building group, and of course, one of them is in our aggressive portfolio, one of the home builders. But it's a group that I think it's worth sticking with. All right. And then computer hardware. I've been touting Apple for a while. Love what's going on in computer hardware. Apple breaking out to a new high on Friday, and you can see computer hardware strengthening. I think we're going to have a blowout report coming up with Apple. All right. I mentioned that there was a company that had beaten or was raising guidance this morning, and I believe this company is in our strong earnings chart list. Came all the way back down to gap support, and now they are raising guidance. Not a shocker. But here was the gap up right there from earnings. Look at the big volume on earnings. Huge hollow candle. Get all the way up to 31, pull back. Look at where we went to, almost exactly, closed almost right on gap support. Now they raised their guidance. I didn't look to see what stock's doing pre-market, but I wouldn't be surprised if we have a nice move up there on the Simply Good Foods company. Some upcoming earnings report I'll just mention. Tomorrow, we've got Domino's, Helen of Troy, Hell. I'm going to pull that one up real quick. That's been a company that has reported some pretty good earnings results in the past, and it has been looking pretty good. It's at a new high. If this stock beats and then moves lower, I would still keep it on your radar. It's been moving up. It's near a high, so maybe a lot's built in. If they report good numbers and gap up, and you see a bearish engulfing candle or something, maybe you wait on it. Maybe it goes back to the 50-day, maybe even down to 147 and a half. But this is a company that I would continue to watch closely. They report their earnings tomorrow. Thursday, we got Delta Airlines. And then Friday, really, in what I think kicks off earnings season, we got Citigroup reporting along with Fastenal. And then things will really begin to start picking up with the big banks next week. All right, last thing, 3 you must see. I'm going to just go right into the scooter report. And we just talked about relative strength. Well, if you go into stock chart scooter reports, large cap stocks, they got everything ranked for you. It's a different ranking system. But I thought what I'd do is just spend time on these 3 stocks. These are the 3 highest scooter ranked large cap stocks at stock charts. Let's pull up the charts, take a look at them. CINF, this is Cincinnati Financial. Look at the stock making another breakout last week. So yeah, the weakness comes in, the stock pulls back. It's just an opportunity. Stock comes right back up now in 2 days, buying back to a 52-week high. Tremendous performer here. And I'll pull it up on a relative chart so that you can see one thing in common with these stocks. They all have this really nice relative strength versus their peers, versus the S&P 500. And not always, but a lot of times, their peers versus the S&P 500 will be strong. Cincinnati Financial, I think, looks really good. Next up was Target. Target was the second ranked scooter stock. I mentioned Target in one of my daily market reports last week. I said I thought 105 was a key area, short-term area where you could consider getting in. Stock had a nice rally Thursday and Friday. I think it's going to break out. Look at the relative strength. Target really looks good versus the broadline retailers. Now, in this case, broadline retail hasn't been that good, but as long as Target can continue to outperform both its peers and the S&P, I think you got to respect it. Finally, KLA10 Core. This is the top performing stock according to the stock charts technical rank among the large cap stocks. This is one of our stocks in our income portfolio, and to be honest, it's the one that's carrying the load. KLAC has been a great performer, huge uptrend that's been in, and look at this. The weakness last week takes it down to its 20-day moving average and then comes right back up, rallying. So really good action on KLAC. I think this one goes higher along with the semiconductors as a group. All right, that is it, and it is going to be a wrap for today. I appreciate you all coming in here. Really enjoy doing these shows. Spread the word. Love to have you in here throughout the week. I do it here Monday and Wednesday at Earnings Beats, and then on Tuesdays and Thursdays over at Stock Charts, Trading Places Live. So make sure you check that out. Anyway, everybody have a great morning, and hopefully see you on Stock Charts TV tomorrow morning. Happy trading.